Hello, everyone. My name is Daphne Urchek, and today I'd like to go over the basics of investing, more specifically, why to invest at all, and a little bit about the stock market. So, there's a lot of different types of investments. Investing basically means making your money work for you. So, the stock market is a very popular form of investing. It's easy to use. Um, Everyone over the age of 18 in the US has access to it. Um, there's a variety of types of investments inside the stock market. There's dividends, there's low energy, high energy stocks, uh, and it's an easy exit, easy entry. It's highly liquid. You can always sell your stocks. You might not get the same amount of money you paid for them, for better or for worse, but you'll get them. There are many different forms of property. You can buy a house. Some people like to buy duplexes, live in one, and rent out the other. Some people buy houses just to rent them out or to put them on Airbnb. The thing about that is housing is unpredictable. Recently, we had a surge in housing prices, and rent is going up in a lot of places, which is good for the landlords, bad for people who want to get into the business of owning property or even just buying one home to live in. But even just buying a family home, property in the US is assumed to be appreciating in value. So it's going up. You might have heard like your parents bought a house 20 years ago for 100,000 and now it's worth 200,000. They didn't have to do anything for that to happen. It just time passes and the market does what it does. Some people buy houses to flip them. Um, the thing about property is it's not as liquid. You have to find someone in that specific place who wants to live there or wants to buy that house. It's, the stock market, you can sell your stocks anytime during the open hours. Property, it takes time. It takes a lot of time, and you kind of got to get lucky too. Some people get really unlucky, and that's a risk. Cryptocurrency. Cryptocurrency is fairly new. It's not incredibly new. I'm sure everyone's heard of Bitcoin at this point. It is higher risk because it's more volatile. Um, and there's a lot of unknowns personally about it. Some people know a lot about cryptocurrency. And I'd say before investing in stock market, property, or crypto, you should take time to learn about it. Because that's how you make money on your investments, is what's happening with them. Um, it kind of has an unlimited potential. There's new coins being introduced every day. Hear about Dogecoin, Shiba Coin, there's like a Moon Coin. And the thing is, like, a lot of these coins go absolutely nowhere. But some of these coins go up 1,000% a year. That is an insane amount of return on your investment. It has a very low barrier of entry. You got an online wallet, transfer some money to that, and then you buy coins. It's kind of like the stock market in that way. It's also incredibly liquid, where you can always sell your coins. Um, Again, you may sell them for a loss or for a gain, but if you need money, you can get your money. It's easy to start. It's hard to master. It takes time to learn about this new thing, and it might be difficult because it is new. There might not be the amount of resources there are about the stock market, about property, but you're also one of the first people to this new form of investing. So, but today we're going to talk about the stock market. Specifically, there's different types of stock. So, just an overview on what a stock is. A company wants to get more capital, money. They need more money, usually to build, to expand. And so they offer people the opportunity to buy a portion of the business. And that is a stock. A stock is a portion, a very small percentage of the business. So when the business makes money, hypothetically, the stocks should be worth more money. So you hold the stock hoping that the business does well and hoping that you can eventually sell the stock for more than you bought it. An index fund is a less risky stock in general. Single stocks tend to be more risky because it's that one company. If that one company goes bankrupt, that's it. No more stock. But if you invest in index funds, there's a lot less risk there. Essentially, an index fund is a big bowl of soup of a bunch of single stocks. So it might be a pinch of Apple, a shake of Microsoft, a little bit of Delta. It's a big mix, and it trends as the market trends. So if the market in a year has gone up 15%, ETFs are probably going to look very similar. And a lot of people, very smart investors, Warren Buffett, etc., pretty much say that you can't beat the market. So if you can't beat them, join them. Get your index funds. They're low risk, but you're not going to beat the market. I mean, you could, if you went all in on Microsoft a year ago, you're up 50%. If you went all in on ETFs a year ago, you're up 24%. You don't get that boost above everyone else, but do you need to? I don't know. I think it's a good mix. It's good to have ETFs, especially in retirement, because you don't want to lose that money. High dividend yield. So we talked a little bit about dividends before, how a dividend is it's money that the company gives you for holding onto the stock. So at the ex-dividend date, it's just a date the company picks. Usually a company pays out dividends 4 times a year. Could be twice, could be once, but usually it's 4 times. And they say, hey, if you're holding onto the stock on October 1st, we will find you and we will give you $1 for every stock that you hold of ours. And it's usually pretty low. There's some stocks, high dividend yield stocks, that pay out a significant portion. And you can make a lot of money like that. But it's important to remember that dividends are taxable to you. So, when you do your tax return, you have to put in how many dividends you earned for the year, and you will then be taxed on them if they exceed a certain amount. Dividends are a good way to compound your investments. So I mean to say, if you get a dividend of $1 and then you put it right back into that stock, you buy $1 more of that stock, and you keep doing that, that's an excellent way to compound your investments. But keep in mind that some stocks do not give dividends at all. Instead of giving money to the investors, they reinvest in the company, which is good too. All right, IPOs. IPO stands for Initial Public Offering. So unlike ETFs, high dividend yield, any other stocks, these stocks are not traded on the stock market. An IPO is the first time that the company sells the stock. So you're getting this stock directly from the company for a price that they have determined. This can be fairly risky. It's a new company. It's not been on the market yet. It's just going public now. You aren't really sure what's going to happen, It's riskier, but you can also get in on the ground level. If you know a lot about the company, Uber was private before it went public. A lot of big companies start, Tesla was private before it went public, but if you have faith in those companies and you want to get in before everyone else, you can buy some IPOs. Investing might seem like a lot of work, and it's more work than it's not, but it's worth it because money in investments grows. If you put $1,000 away when you're 20, by your 30, it's almost doubled. By your 40, it's almost doubled again. By your 50, it's 7,600. By your 60, by when you're 60 years old, it's almost $15,000. And that's assuming an annual return of 7%, which is pretty much what finance people like to assume about the stock market, 7% return, as like an average. And that's without adding any more money to this investment. You just start with 1,000, and by the time you're ready to retire, a little early at 60, it's 15,000. I do want you to keep in mind, this is not regarded, like this is without taking in inflation numbers. So $15,000 at age 60 is not the same as it is, 40 years earlier. But the alternative here is to save that money, right? We assume initial savings of $1,000 at age 20. It's in your bank account, you've saved it. It's, let's say, your emergency fund. You're not putting it into stocks, you're just holding on to it. At age 20, it's $1,000, right? But inflation is 3% generally. This year it was worse. But like I said, finance people like to assume 3%. So by age 30, not only has it, it's not gone up, it's gone down because banks pay you 0.0 or 0.1%, I think, on interest, something like that. Practically nothing. Every now and then I'll get like 50 cents from my bank and be like, oh, that's great. Thank you. By age 40, it's $50. By 50, it's $401. And then 60, it's $300. This is taking into account inflation. So this is only inflation. It's worth less money. Money today is always going to be worth more money than money tomorrow, unless you invest it. So, to start investing, I would recommend Robinhood. You can also do something like Vanguard. I like that for retirement funds that I don't look at a lot. But for single stocks, and I like to buy my ETFs on Robinhood because it's free. It's completely free to you. Robinhood, I would recommend getting it on your phone or your iPod, as it was built as an app before it was built as a website. So the website it can't do everything that the app can do. I mean, it had a couple of rough bumps every now and then. So if you're trying to like be on the stock, day trading and stuff like that, maybe not the best. But if you're putting the money in, looking at it twice a week, this is fine. This is absolutely fine. So you're going to want to enter your information. It's safe. You're going to fill out some federal government forms so they know who you are, so they can track how much you're earning, so you don't commit tax fraud, But it's good. It's going to ask for your social security number. Again, that's just so the government knows how much you're making. And if you use this code, you get a free stock. And you can play around with that stock. You can watch it as it goes up and down with the market. And then when you get comfortable with that, you can start adding money to it and buying your own stocks. So I'll do a more in-depth video about Robinhood if you guys want that. But yeah, so be sure to use that code or else you won't get the free stock, because then I also get a free stock. That'd be nice. All right. Thanks for watching. Bye.